Hey guys, welcome back. So, John C. Bogle, known to his friends as Jack Bogle, is one of the all-time great legendary investors. He was the founder of Vanguard, he gave birth to the index fund, and as Warren Buffett said, has done more for the individual investor than just about anybody in history. Sadly, Jack passed away in 2019. However, his investing philosophy and also portfolio strategy does live on. His net worth was around $80 million, and he dedicated his life to make sure that it was the investor, not the corporation, that took home the lion's share of the profits. So in this video, I'm going to be showing you the Jack Bogle portfolio for 2021. And the reason I know this is because his portfolio strategy didn't really change. In addition, I'm also going to show you how to get to the $1 million mark using index fund investing. I'm also going to show you how fees can kill your gains. As I think many people say that fees are important, however, I'm going to show you an eye-watering example of just how fees steal your wealth. As always, if you do find anything useful in the video, don't be shy, be sure to drop a like. That would be very much appreciated. Okay, so sit back and relax guys. Here is the portfolio strategy from legendary investor Jack Bogle. Okay, so here is what we've got coming up. We're first going to take a look at the Jack Bogle portfolio for 2021. We're then going to take a look at the index fund strategy, and I'm going to show you what it takes to get to that $1 million mark. We'll then take a look and I'll give you an eye-watering example of how fees can kill your gains. And then we'll finish with a bonus clip, Jack Bogle explaining about asset allocation. Okay, so drum roll please. Here it is, the Jack Bogle portfolio. And it is 100% in stocks. And Jack Bogle's favorite index fund was the US Total Stock Market Index Fund. So there is a big debate of how much money should be in bonds and how much money should be in stocks. But he always said for maximum returns, you would be 100% in stocks. Yes, this is going to be more volatile. You're going to have to go through 10%, 20%, even 50% drops. But over the long term, this will outperform a split against bonds. More specifically, if you are US based, then the index fund is VTSMX, the ETF version is VTI, and for UK people, it would be on the Vanguard site US Equity Index Fund. So I thought I'd check out and see how VTI has performed over the last 10 years, and the performance has been excellent. So I just took a slice of the last 10 years and it performed pretty much 200%. So that's a 200% growth, giving an average of 20%. Now, just bear in mind the historical average of the S&P 500 is closer to 10% compounded. So US stocks are outperforming the average. But Jack Bogle also constantly reminded us of reversion to the mean. So we could see a lower performance in the years to come. However, over the long term, you're going to get around about 10%. Then, as you age, he mentioned about having a very rough guide of bonds to your age. Even though, having said that, in Jack's later years, he still had about 50% in stocks and he had 50% in bonds. When it comes to which bonds he used, Investopedia had said that it was a split between intermediate bonds and also inflation-protected bonds. So this is more of what his retirement portfolio would look like. 50% in a US total stock market fund, 50% in bonds, split between intermediate bonds and inflation-protected bonds. Owning the stock market over the long term is a winner's game, but attempting to beat the market is a loser's game. So now I'm going to show you the big picture index fund strategy and how we get to that $1 million mark. But essentially what we're doing is using our money to make more money, and we're leveraging compounding. So let me give you a few different examples. So starting with 50,000, now this could be $50,000, pounds, euros, depending where you're watching. Historical average has been 10% for the S&P 500, and you would have to wait 30 years to get to that $1 million mark. And we can play around with these variables. You can put more money in and it'll take less time, or you can put less money in but it'll take more time, or you can get a higher return, lower return. But let me give you two more quick examples. This time, if you were only able to squirrel away 25,000 at 10%, you would have to wait 40 years to break through the $1 million mark. And finally, if you could put away over 100,000 at 10%, you'd only have to wait 25 years to get to that $1 million mark. Buying funds based purely on their past performance is one of the stupidest things an investor can do. Okay, so as I promised you guys, an eye-watering example of how fees can kill your gains. So in this example, it's still using $50,000. Now the fee on this fund is going to be 2%. Average return of 10% a year, and this is over 32 years. So this is how much your part of the fund would be worth. This is how much you've lost due to fees. So in total, over the 32 years, it made over $1 million. However, just this small, little, insignificant 2% had taken 44% of your total fund. And I urge everybody who's watching to dig into the black box, which is pensions. My question to you is, do you know exactly where your pension money is being invested? And also, do you know the exact breakdown of all the fees you are paying in your current pension? Because there are tens of thousands of people all around the world putting away pension money, and they have no idea where it's going or what they're being charged. And if I can continue Jack's work and help people save, because these toxic funds taking 44% of people's retirement money is not good enough. On a more positive note, let's take a look at a Vanguard index fund. This time, everything's the same. The only difference is your annual fee is going to be 0.1%. So this is what the fund will be worth, and this is what would have been taken away. So the fund total is exactly the same. You have made over $1 million. However, this time, you've only lost 2.8% to fees, and you are the one that keeps the million. Don't do something, just stand there. And I do love this quote, as basically what he's saying is that 99 out of 100 times when things are going on in the economy and the market, the best thing you can do is nothing and just keep adding to your index fund. Okay, so time to finish with a bonus, and this is a clip from Jack Bogle himself discussing asset allocation.
What is the simplest 10-minute solution or half-hour solution to getting Vanguard returns?
Well, I'll give you a simple solution. But the one thing we know about the average is, unlike Wobegon, there are a whole lot of people that are here and here and here, and the average is here. So in essence, nobody's average. You're all a little bit above average or a little bit less than average. You may have greater risk tolerance. You may have greater income requirements. You may have greater financial ambitions and are willing to take risks to accomplish them. But in all those cases, the lower the price you pay for owning the stock market and the bond market, the better off you are. Now, I have talked about a rule of thumb, and I want to underscore it's a rule of thumb, a place to begin thinking about having your bond position equal your age. So when you're 20, you'd be 80% bonds. And that's a rule I would not
80%
dream
stocks.
of, 80% stocks. And I wouldn't dream of telling somebody to their first investment to be 80% in stocks. They should be 100% in stock. In the first year, maybe they'll put away $1,000. That's a drop in the bucket compared to the value of their career and the value of what the investments will ultimately be. And by the same token, at least at these interest rate levels, I'll comment on that in a second, I wouldn't dream of telling everybody who was 87.
You say that with pride. You say that with pride and enthusiasm.
To be 87% in bonds. I am not. I'm approximately 50-50. And so a lot depends on your own requirements. And this rule of thumb, first of all, very important for people to think about, and that is just about everybody that you're going to be talking about, every investor you're talking about, also has Social Security. And that has a capitalized value. What does that the size of that asset pool you would need to create the returns you get in your monthly Social Security check. Probably $350,000. So if you have $700,000 and $350,000 in Social Security, and you put 100% of your stocks into that, so it's $350 in stocks, $350 in this bond-like investment, and you're 50-50. So take that into account. If you have a pension from a local government or from a corporation that's not going to go bankrupt, I quickly add, you should add that in. What you're trying to do when you retire, which I am going to do someday.
I think you're going to fail at that. I think you're going to fail at that.
Would
Jack.
not be my first failure. But when you want to do that, you want to ensure a monthly flow of income. So don't watch the market. Just make sure your portfolio is producing income and will continue to produce income. So you get your Social Security check every month. You set up your mutual fund account or your index fund account for a monthly payment. You can do that. And just you want those payments to be stable, and with respect to Social Security and the fund alike, will grow a little bit over time. Dividends are an extremely important part of this.
So there you are, guys. That was the Jack Bogle portfolio of 2021, as he would call it, the hedgehog strategy, being able to do just one thing really, really well. You also saw what the big picture of index fund investing looks like and how to get to that $1 million mark. And I also showed you just how crippling fees can be to your portfolio. And I urge you to dig into your pension and find out exactly where is the money being invested and just exactly what fees are you paying. Okay, so hopefully you found something useful. In fact, just one favor to ask. If you did find anything useful in the video, then be sure to drop a like. That would be very much appreciated. If you haven't yet subscribed to the channel, I invite you to click below and join us. I do have some great videos coming up that you don't want to miss. Okay, cheers guys. Thanks for watching, and I'll see you in the next video. Bye for now.